With LIC IPO fever gripping the country, there are many retail investors who want to participate in this frenzy. With stock indices trading at an all-time high, such a frenzy of new issuances is expected with more IPOs lined up to hit the market. However, every new entrant in the capital market should be assessed well on various factors before investing, as they may not be as promising as being portrayed by market intermediaries. One needs to understand that just like the stock market, IPOs come with a fair share of risk and due diligence is required before investing in them. Should you invest in an IPO, there are certain key points that you need to keep in mind. Well, before we jump into knowing those key points, let's first understand the basics of IPO. So what is an IPO? Well, initial public offering or IPO is a unique process of converting a private company into a public company by issuing shares. The issuance of shares for the public allows the company to gather capital, and it is an excellent opportunity for the general public to invest and earn returns on that investment. Initially, a private company grows with the initial investors, founders, and stakeholders. Now, when the company has achieved a specific goal wherein the management realizes that they are stable enough to handle the SEC, which is the Securities and Exchange Commission regulations, they realize that they can grow and they can diversify using the general public's money, then the company decides to offer an initial public offering. Through this process, the stakeholdership in the company is also offered to the general public through shares. So, coming to the next question, how does IPO actually work? So, like I said, the IPO is the entire process of converting the company from private to public. Before an IPO, a company is considered private. As a pre-IPO private company, the business has grown with a relatively small number of shareholders, including early investors like the founders, family members, friends, along with professional investors. An IPO is a very big step for any company as it provides the company with access to raising a lot of money. This gives the company a greater ability to grow and expand. The increased transparency and share listing credibility can also be a factor that can help the company obtain better terms when seeking borrowed funds as well. Now, there are two types of IPOs in the market, and that depends upon the type of price generation the company or the underwriter is going for. These are categorized into two types. The first one is fixed price offering. So, in fixed price offering, the company decides the price of the stocks initially, and then any buyer or the investor pays that particular amount per share to obtain any number of account or the shares they want to hold. Well, the second one is book building IPO. Now, in book building IPO, the company decides the price band of the forthcoming IPO, where the floor price is the minimum and the cap price is the maximum, and the bidding process is done within which range the price of the share is decided. The price is set by the underwriter and the company's investors with the survey done on what would be the value of the share. The bids are made and then the selected investors get the stocks. So why exactly IPOs are generated? What is the need of launching the IPOs then? Well, there are only two reasons due to which any company issues an IPO. The first one is to raise capital or return the money to the initial investors. The company opens itself to the public investors by releasing an IPO. The IPOs give them the greater domain for the amount of investment. They can raise much more money than they could ever raise by the private investors. While the other reason the company considers releasing an IPO in the future is that it attracts initial investors. The investors have an option to sell their stocks in the company and then get the return on their initial investment. Now that we have known the basics of IPO, that is the meaning of an IPO, what are the types of IPO, why does the company issues IPO, etc., we'll now get into understanding what are the key things that you need to keep in mind before you invest in any IPO. So the very first one is read the DRHP thoroughly. So the draft red herring prospectus or DRHP of a new entity offers a detailed insight into the company that is coming up with an IPO. Filed with the Securities Market Regulator SEBI, the DRHP is an important document that entails crucial details about the company, including its business, the past performance, the asset and liabilities, why and what it intends to do with the proceeded raised through the IPO, and the possible risk factors that could impact the company's performance and thus the share price going forward. So you need to make sure that you do not skip reading it thoroughly before you decide to invest, as the DRHP provides critical information that can help you understand the business better and make you an informed investor. The next one is purpose of capital raised. So the why factor about the need for capital by the company should always be given the utmost importance. Now, for example, if the company is burdened with debt and they are mentioning it in the DRHP that the proceeds will be used to pay off the existing debts, then you should definitely be cautious of such issuances. However, on the other hand, let's say if the utilization will be done for the mixed purpose of debt payment as well as expansion, then you can consider investing in that company. Also, if the company already has a growth chart of the profitability with a reasonable cash balance and wants to put the proceeds solely for the expansion of the scale up and reap benefits, then you should surely consider and taking this opportunity and investing in that company. The next one is know the promoters. The people who are running the show in the company should also be given a close look. This includes the firm's promoters and other key officials in the management. Since these personnel are the driving force of the company, the growth prospects largely depends on their ability to make the right business decisions. An investor should take note of the number of years the key management officials have spent with the company. The next one in the list is potential growth drivers. Now, factors like the company's positioning in the sectors it operates in, its market shares, the accessibility and visibility of its products, geographical spread, the expansion plans, estimated profitability, supply chain, ability to handle crisis, and efficiency could be among the various growth drivers which could decide the upcoming business prospect. So you should not overlook these factors. The last one is risk factors. Now, when you subscribe to a share during an IPO, you become one of the first shareholders of a company. As the company flourishes, the share price will rise and you will stand to profit. But there is also the risk of stock markets. The returns on your investment will depend on the growth potential of the company, and if the company fails, you will also risk losing your money. Particularly in the case of unlisted companies, one has to be very careful as these companies are not required to publish their financials and thus you cannot analyze their past performance. Therefore, attention must be given to the risk factors mentioned by the company in its DRHP. These act as a filters and can either make or break the deal when it comes to investing in IPOs. So these were some of the key points that you should take a look of or you should keep in mind before you invest in IPOs. So just like any other investment, assess your risk-taking capacity before investing. You should invest according to your risk appetites. If the business looks too risky as per the advice of the market participants and it does not match well with your risk-taking ability, then it is better to avoid investing in such IPOs. Further, if the valuation of an offer does not match up with the growth prospects, you should give it a miss. Doing your own research is something that you should consider before an IPO. Fresh issuances should not be taken as a quick money-making instrument. At the very same time, it is equally true that you don't need to invest in every IPO. It's important to make decisions depending on how much risk you can take. Needless to say, an informed investor performs well in a long run. Also, if you're someone who is interested to know more about IPO, the entire process of an IPO, then you can download our Financial Freedom app, wherein we have developed an exclusive course for you guys about IPO, wherein we'll teach you every detail related to IPO. So hurry up and download our Financial Freedom app and get access to abundance of knowledge regarding finance, agriculture, business, etc. Also, before going, do not forget to hit on the like button, subscribe to the channel for more such financial content, and lastly, do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.